In this video, I'm going to demonstrate evaluating transfer pricing systems using exercise 1533 as an example. So we have a company here that has a manufacturing division and a marketing division, and they're both evaluated as profit centers. Marketing does buy products from manufacturing and then they repackage them for sale. Manufacturing, though, also sells some of those same components to third parties in addition to marketing, so it has other opportunities. Now I'm going to focus initially on the information for manufacturing. Its capacity is 1 million. The selling price to outside third parties, so it may not necessarily be what they charge marketing, is going to be $1,400. Their variable cost per unit is going to be 560, and fixed cost in total is going to be 10 million. So we're going to see two different situations. The first situation, A, is we assume that the current production level in manufacturing is 600,000. So that's where they're at now without any association with marketing. Marketing has come and requested an additional 100,000 units to produce a special order. So that'd bring them up to 700,000. And they're asking what transfer price you would recommend. So as you recall from reading through the chapter, the key thing is that particular division or unit of the business at capacity or not? Recall capacity is 1 million. We would be at 700,000, or manufacturing would be at 700,000 with the additional 100,000 units. That is below capacity. When you're at a situation that you're at below capacity, the typical transfer price that's going to be negotiated is variable cost. Because what you're saying here is, okay, it's not like I'm turning down business. I'm not turning away $1,400 from somebody else. I don't have the additional business. So from a company perspective, it doesn't make sense for one division to charge a third-party price because they can't at that point get it from somebody else. The most logical charge is, what are the additional costs that manufacturing is going to incur to produce those, and let's at least cover those to make the sale to marketing. And those additional costs are the variable cost of 560, because keep in mind, fixed costs shouldn't change based upon a volume level change from 600,000 to 700,000. But we're also going to address a second situation in B. Let's assume that manufacturing is already at capacity. So let's say they're already at 1 million and marketing comes and knocks on their door and says, hey, I want 100,000 units. That would take them definitely above capacity. That changes our transfer price from the variable cost to the selling price for the third party, which is $1,400. And the reason why is to take that business now and give that to marketing. Manufacturing is going to have to turn away third-party business at $1,400. So it makes sense, if they're going to turn away a third party, they're going to demand the same price of $1,400. So to summarize, the overall rule of thumb is, if we're at below capacity, the typical negotiation is variable costs or any outlay costs. If we're at capacity and turning away other business, then the negotiation is the selling price or typical selling price to a third party.